Hello and welcome to Money Maximized. Today we are going to talk about inflation's ripple effect on global trade. Inflation can significantly impact international trade by affecting a country's competitiveness, trade balance, and trade relationships with other nations. Here are the key ways in which inflation can influence international trade. Competitiveness. Inflation can affect a country's international competitiveness by influencing its relative price levels. High inflation tends to increase production costs, which can lead to higher prices for exported goods, potentially making them less competitive in international markets. Export demand. Inflation can reduce the demand for a country's exports, especially if the inflation rate is higher than that of its trading partner. Foreign consumers may find the country's products more expensive, resulting in decreased export demand. Exchange rates. Inflation can influence a country's exchange rate, which in turn affects its international trade. High inflation often leads to depreciation of the domestic currency, making exports cheaper for foreign buyers, but increasing the cost of imports. Trade balance. Inflation affects a country's trade balance by altering the prices of imports and exports. If a country experiences higher inflation than its trading partners, the cost of its imports may rise more than the cost of its exports, potentially leading to a trade deficit. Import costs. Inflation can increase the cost of imported raw materials, components, and finished goods. This can impact the cost of production for domestic industries that rely on imported inputs, potentially affecting their ability to compete internationally. Influence on tariffs and quotas. Inflation can lead to adjustments in tariff rates or import quotas. Governments may modify these trade barriers in response to changes in domestic price levels to protect domestic industries or encourage imports, which can further affect international trade dynamics. Trade agreements and contracts. Inflation can affect the terms of trade agreements and contracts between nations. Inflation may necessitate renegotiation of agreements to ensure fair terms, especially if it impacts the real value of exchanged goods and services. Trade policy adjustments. Inflation can lead to adjustments in a country's trade policies. Governments may modify trade policies, subsidies, or export incentives to mitigate the impact of inflation on trade and maintain global competitiveness. Investment and foreign direct investment, FDI. Inflation can influence investment decisions, including foreign direct investment. High inflation may deter foreign investors, impacting capital inflows and the overall investment climate in a country. Understanding the implications of inflation on international trade is crucial for policymakers, businesses, and stakeholders involved in global commerce. Managing inflation effectively and implementing appropriate trade policies can help sustain a country's trade relationships and promote economic growth on the international stage. Thanks for watching, and don't forget to like, share, and subscribe.